Well, good morning, folks. Hope you're doing well. All right, so we are looking at a day with PMI numbers at 9:45. So I'm going to watch and see how we behave in price going into that number and how we have whatever liquidity or inefficiencies around markets at that time. So give me a moment here. I'm waiting to see what my delay is like.
When we came up with our
This is audio check just to see what time it takes to get to you. Looking at trading view, the time is 9:24:48. It's 20 seconds according to my test here. So there's a delay of 20 seconds. It's actually a little bit longer than that. It's almost 30 seconds. So let that be a reminder to you. What I'm saying may not get to you until a half a minute later. Okay. As a reminder, yesterday I started off with it's a low probability day. I said that you should not copy anything I was going to do, that you would regret it. And in the comment section, I had people posting that they copied the trade and they got hurt and you didn't listen. So understand that if it's low probability and I'm going to force myself in that situation, that doesn't sound like something that you should run. It's like a burning building. Let me run in after, and see what I can find out. You find out you get burned. So today, we're waiting for the news to hit. And also, I noticed that I had some students that usually live stream. And because you saw me doing what I was doing here, it messed your trades up. If you're live streaming, don't look at me. Don't listen to me, okay? Because I'm probably going to be against what you expect to see in price. And if it messes your trade up, it's gonna, it's gonna make you angry, and it's just gonna mess you up entirely. You should not let me or anyone else influence your trade ideas. But I walked you through yesterday's morning session, how we took both buy side and sell side, and I mentioned how sticking to the bias on the higher time frame that they will want to keep price moving higher. We saw that actually happen. And when I was inside the middle of the range, that is a 50-50. It's real hard to determine from that middle ground where we're going to move from until we get into the latter portions of the day. I mentioned times of macros and such, and I mentioned how the real macros are 10 minutes to the top of the hour, every hour, to 10 minutes after. There are 4 macros in the last hour trading between 3 o'clock and 4 o'clock Eastern Standard Time. I gave you the time yesterday, again, 250 to 310. You go back and listen to the live stream, it's there. And I told you that bias was bullish, and I told you that I still like that buy side as I ended the stream. I recorded myself executing in that last hour's macro, and it ran out. It did way, way, way more than I had in the trade to capitalize on. So, and in the last 10 minutes of trading, which is the 350, market on close algorithm, that macro really sent price up, parabolically as well. And then after the New York regular session, it still kept going. And then overnight, we did more. So I know it feels like this thing should crash anytime. When you're looking at the stock indices, it feels like they shouldn't be. And in fact, that's how I look at it too. Like there's no justification for them to be where they're at. Okay, it's a big Ponzi scheme. But hey, you got to stick with it. until it proves you wrong, when we're in all-time highs and there's nothing, like what do you draw out as a draw on liquidity that's above where you are right now or the highest highs ever made? What are you reaching for? The stars. You know, you don't know how far it's going to go, and you don't know when it's going to end or reverse. So I don't have any tools for that. No one really does. So it's kind of like one of those things where you just have to keep taking buy signals and stick with that as your underlying bias. And if you have something that's really, really set up for like a afternoon lunch hour reversal, that's not a reversal for the higher time frame trend. It just means that it's reversing on an intraday basis to seek liquidity. So since we're underlyingly bullish, you know, in the lunch hour, usually you'll see the market retrace back down to take out a low that formed going into noon lunch hour. So always have your time on TradingView set to New York local time, and the lunch hour is usually like 11:30 to 1:30. So that's technically what, 2 hours, right? So in that field of time, I allow for a stop hunt. And I look for that in the lunch hour. So we're watching it poke here into a new higher high here. I have that on a 5-minute chart. That shouldn't be there. It should be a 1-minute chart. All right, big opening range gap. So this is the opening range gap low, and the opening range gap high is the opening price. Did you guys bother to go through yesterday's price action after grading the opening range like I'm just going to show you here again? Was there any turning points on those same levels projected through the remainder of the day? This is half of the gap, the first quarter, lower third, and complete closure. So without trying to call a reversal, I'm not going to do that because I basically built the case yesterday and starting it off again today, is you don't want to try to predict the top in a primarily long-term bull market. But we can trade back down into here like we saw yesterday, and it still went higher. So I'm favoring a move down to at least mid-gap and how we trade there, and also what levels they leave, if they leave any at all, at 9:45. So if you look at your economic calendar, 9:45, we have the PMI number coming out. So a lot of news, red folder news on Forex overnight. We saw Euro and cable move higher as a result. All right, so we had buy side swept here. This, I don't like this. Usually I would view that as a breaker, but we had this wick go all the way up. Let me widen it out a little bit so we can see the candles better. Okay, so I'm watching this little area right in here. That's your first gap inside the opening range. Now, opening range to me is the first 30 minutes. I don't care what anybody else says about what an opening range is. That's what they're looking at. But opening range to me is the first 30 minutes. So this is your first gap inside that opening range. And you want to keep that kind of like a neutral color. You don't want to have any kind of subconscious emphasis placed on it. Like if I made it orange, you would think it's going to be an inversion fair value gap, or if it was red, it would be bearish, or if it's blue or green, it'd be bullish. That type of thing. I don't want to influence myself or you as a viewer, but I'm watching this gap there. Watch half of this wick, which is consequent encroachment. Wicks are treated the same way in my analysis concepts as a gap. So it'll many times go right back to the middle of the gap, or middle of the wick rather, whether it's a wick to the high end of the candle or the low end. Now I'd like to see it use this here because we failed to get to the halfway point of this gap or wick. We might get to it here. So I'm looking at this level right there. I still didn't get all the other extensions off. Sorry. Okay, and sell side's right here. This is that upper quadrant on the opening range gap. That's what that level is right here. And if I scrunch it up, we'll get down. So there's the upper quadrant. Here's mid gap of the opening range. All right, you see that volume imbalance right here? And we have a gap that is here if this candle can close. If it comes back up to the bottom end of that into that volume imbalance, that can act as an immediate rebalance, and then we could send it down into mid gap. Again, so that way you can see this level here is the upper quarter of the gap that is from where we settled yesterday. And I'll show you with regular trading hours again. See, that's that upper mid gap. That's where I'd like to see it draw down to at minimum. And then down here is the lower quarter of the gap, and here is the full closure. Now, as long as it doesn't tear off for it, if it come back up above this candle's high that we're in and retouch that upper quadrant, that might act as a institutional order flow entry drill, where it just goes up a little bit, leaves this portion open between this candle's low and if this candle can close and not have a complete closure. That would create, in my mind, a breakaway gap, sending us down into here. So I officially registered with the Robbins Cup last night. I'm with Dorman, so that's the broker I elected to go with. I'm not representing them. I don't act as an introducing broker. I don't think you should trade with them. I don't know how else to say it. But out of the choices, I was going to go with Iron Beam, but I was suggested, let's put it that way, to use Dorman over them. So that's what I did. As soon as they give me all the confirmations and give me the okay to send the wire, I'll send that. When Chelsea Robbins gives me the email that everything's on the hunky-dory, I will post that publicly, let everybody know that that's officially, I'm in there and I am funded, okay? But my first trade will not be done in that account until February 6th. Gotta put a password on this thermostat. I go upstairs in my office and my wife turns the heat up. I'm dying here. I have the window open, fan blowing on me. That's what you're hearing, by the way. It's the air coming. I'm literally right underneath that air vent. So if you hear that noise or that sound, I'm right underneath the vent and it's cooking me. So there's a small area right in here. I'm not going to leave this on it, but right there, you see that? I'd like to see that stay open. Okay, I'd like to see that stay open. And right down here is mid gap. And again, for disclosure's sake, I'm discussing price action over the medium of a paper trading account. None of this should be viewed as investment advice. I know some of you are not going to listen to that. You're still going to try to do something based on what I said, even after yesterday, which is, you know, at your own risk, let's put it that way. All right, 4.5 minutes until the PMI number comes out. So if you look at this price swing right here, if they use the 945 news to reach lower, I'm measuring from the body's highest open or close in this swing, which is the up close candle's closing price. And you can check that by up here. This is the close, 692 3/4, and the open is 92.50. So this is the highest one, and I'm dragging it down to the lowest open or close in this price swing right here that I'm circling my cursor. So that's this right here. Now I want to do it half, 1, and 1.5, and that gives me targets to reach for based on this price swing. And I want to look and see, is there anything that overlaps? Now this would have been better if it would overlap with that mid opening range gap halfway point. And now I get a measurement on the extreme wicks, and I get a baseline based on all of them. So it's real close, real in terms of proximity. So I like the idea of it trading down to the mid gap or halfway of whatever the opening range gap was measured from, which are what these levels are showing right here. This is a fib level. So the fib, there's no magic in the fib. Fib just gives me measurements. I treat them as a standard deviation, how many multiplications of a particular range can go higher or lower. And if I look for things that are in close proximity to that other PD arrays, a pool of liquidity, like an old low or old high, I like to see that as my targets. The weakest part I have for my own personal trading is my dissatisfaction for my exits. I want them to be better than they are. And when I'm on side and I'm getting out profitably, they're good. You know, I mean, you've seen examples of it, but to me, that's the part I wish I could strengthen. Like I want that to be better. I'm always striving for that. So we're 1 minute and 15 seconds away from the PMI numbers coming out. I'm watching to see if they shoot it up into here or even exaggerate up into this initial fair value gap. If it hits that and rejects, then that will be where my objective is. I don't want to get in ahead of that number. I ended the day positive yesterday. I saw the savages on Twitter were happy yesterday. That's good. I'm glad. Have that energy here in a couple weeks. And how about trades by Matt? Round of applause, Mr. Miller. Well done, sir. Well done. Last year you made it on the leaderboard. This year you're in a number 2 spot. You are technically what they call the shit right now. I was teasing him last night about it. That's awesome to see him doing it. All right, 4 seconds. There we are. Let's see. I was expecting to see a little more movement in this. We're waiting for you, ICT. Put your stop loss out there, buddy. Yeah, how about that? Yeah, like I think 16,000 consecutive viewers. That was like my high that I saw. I don't have a measurement because I don't see how many's watching right now, but I peeked at it when I was changing screens to go back to OBS to check my microphone and sound, and it flashed up that there was like 16,000 people watching, which is a little unnerving to be honest with you. It's a lot of people watching you. But imagine if just 10% of individuals put a trade on and put their stop loss right where I was putting my stop. That creates a huge pool of liquidity in a very narrow range day yesterday. So it was real interesting to see how it would go right to the stop loss. And didn't go anywhere else after that, but it would just go right to the stop and then right back to the middle of the range of the day. And that's also one of the reasons why I was telling Joel Robbins I don't want anyone copying my trades there. Because it sounds like a wonderful idea. If this guy's good or whoever's good, you follow them, and whatever they do with their account, you can do too. But if there's a large following, okay, um, apparently when I go somewhere, it's like a carnival behind me. So that would create a huge pool of liquidity. And if I was a market maker, I would fleece it too. Who wouldn't? You would do it. And if that's the easiest, largest pool of liquidity to chew into on a low range or small range day, then it goes without saying it creates that very issue, which would plague me as a trader. So if I'm trying to have really good precision and well stop placement, but then I have everybody else hitchhiking on that same idea, it creates too much of a pool of liquidity that the market will absolutely just go and run for. So for the people that are neophytes, that are just completely green to it and have no idea what they're doing or what they're talking about, someone that has a huge influence to create liquidity because they're being copied, that would be counterproductive for me. So I want to be able to get in and out of trades with no problem, not create liquidity to be drawn to. And that's a large pool of liquidity would be created as that. And there's no way of escaping it. Robbins and whoever else would be associated with it, they would be profiting because of the churning of the participation of following whoever it was. But me as the trader, that would be, number one, it would be in my head messing me up, because I would feel like I'm trading your money, which I'm not. All right, my attention is right back to this fair value gap. So I'm watching, see if it can bump the bottom end of that. Not on the same candle though. I would feel better about had they gone down here and upset these relatively equal lows, and then if it made a run above this high, then it would be easy for me to fall back and sync with, okay, I'm going to stick with the higher time frame bias, and then maybe treat this as an inversion fair value gap, this one here. But the fact that they left that like that, it just feels like bait. So I'm going to wait for 10 o'clock and see if I can get a turtle. Not a turtle. I was going to say turtle soup. I'm going to get me a silver bullet if I can find one. I mentioned that if the market was going to run a little bit yesterday, I would drop down into lower time frames underneath the 1 minute chart. So that's kind of like what I want to try to do and focus on today, to try to show you what it looks like on a lower time frame in relationship to everything else I'm looking at. I'll change this one here to a 5 minute. Change this to a 1. And we'll go down into a 15-second chart here. Okay, so we found our way up into that first initial fair value gap of the day. We have a minor sell side liquidity pool right here. This is mid-range open gap. Nothing to get excited about here yet. Got a lot of appreciation in the comments about what I taught yesterday in regards to inversion fair value gaps, the opening range gap. I appreciate that. So for lower time frame charts, like less than 1 minute, 15-second, 30-second, 5-second, 45-second, anything interval below 60-minute, I'm sorry, 60-second charts or 1 minute charts, they can be utilized to run 5-minute price runs, 10-minute price runs, 15-minute price runs, hourly price runs, or you can utilize them to get in sync with the marketplace. If you miss a really good 15-minute entry or a 5-minute entry, or you miss the perfect 1-minute entry, the 15-second or 5-second is very forgiving, because let's say you saw that the market was likely to go higher and you missed the ideal entry on a 1-minute fair value gap and it runs off. Well, if you drop down less than 1 minute, you'll pick up a lower time frame fair value gap that's going to act the same way, because price is fractal. And also, by linking that same idea to the structure on the 1-minute chart that would have been your initial entry, your stop can actually be even less than that, because you're using a smaller time frame. So everything in this price action here, this is not conducive of any one direction at all. This is simply just going back into our first fair value gap, which could be a rotation in here or go higher. I don't have any trust in it yet, because I don't have anything except for it coming down to this area into this buy side imbalance, sell side inefficiency. It's not enough for me. It's not good. On the 1-minute chart over here, I don't have anything to offer myself a sound entry on. All we're doing is trading to a gap. And just because there's a fair value gap doesn't mean that's a trade. So up here on the 5-minute chart, this is our civvy there. Okay. So we had this high, low, higher high, broke lower. In a bearish market, this is a shift in market structure, bearish there. But against the higher time frame, I'm not looking at it like that right here. I would demand more information from price. And I want to be inside that post 30 minutes, 10 o'clock to 10:30. That's where I want to have my first entry in there. The problem with that is, I'm going to take this off. I don't like to leave this stuff on the chart, but if I don't draw attention to it, you won't know what I'm referring to and where my focus is. So you'll have to forgive me if you want to see these things stay on the chart. I can't. It's too distracting. But those are the places in which I'm focusing on as it relates to the 5-minute chart. Pound dollar has a weird double top in there. I'm just looking at, I have all my monitors open today. I'm working off my laptop, but all my main hardware is in front of me, and just caught my eye that it's a weird looking double top on pound dollar. Some of you forex traders' ears just perked up. He's talking about FX. You get the feeling why I stopped trading forex now? Sloppy, isn't it? It's real frustrating over there. Bad stuff coming, that's why. All right, so S&P looks like it wants to drop in here. Let's take a quick look at ES. Let's pull that up on a 5-minute. Sell side. Not yet. You guys are jumping on that ES, aren't you? Can't help yourselves. NASDAQ's being a little bit reluctant. I'm going to try. Don't want to do that. So S&P went down and hit that sell side. I just made mention of. Let's take a quick look at that. Okay. And let's go back to NQ. What I want to see is NASDAQ want to roll over and replicate essentially what ES has done. ES is leading to the downside. ES picking up momentum on the downside. Want to see NASDAQ lose some ground in here. I'd like to see it give way harshly below these lows in here. Dow's fallen precipitously. NASDAQ is holding up, being a stubborn old bird. Go up down real quick, let you see it. That's Dow. There's ES. And I was drawing out the liquidity over here, these relative equal lows. So when I'm looking at price, my eye jumps right to where it's smooth. The smooth edges get made jagged. And then let's go back to NQ. Look at that. You guys are following my stops. Remember I was saying in the first few minutes of the stream, if everybody goes to the same place at the same corner, that's where the drive-by is going to happen. I was telling my private students that this is an interesting observation, because if I place my stop publicly and people are going to be following me in a large degree, that's creating an engineering liquidity. NASDAQ won't drop. S&P dropped. Dow dropped. There's your stop. You don't think these markets are rigged? They're rigged. They're going to gear. It's going to go right where you're going to be at. If you're large enough fish to fry, they'll fry you. Now explain why both the Dow and the NASDAQ dropped off, but the one I'm putting myself into in front of everybody, they're going to say, no, we're not going to take it down there, ICT. They're not rigged. They don't go for your stop. Yes, they do. They even left this right in here. And dull this one here out a little bit. Watch this one here. And that's why I don't want people copying me. Some of you young bucks out there think you know stuff. Oh, that's his excuse. You're watching it. You literally watched it happen here. You can't have a better testimony to why I don't want to do it. ES is off that run on that sell side pretty nice. Let me take a real quick look at that on the stream. I can see it from my charts, but I want to be able to bring it up here. I want to see if it can support ES in here and start going higher, then NASDAQ will probably have a sustained run above its initial high of the day. Nice reaction off of that. See the body? So it would be reaching for that high. Right there. I wanted to see this candle here come down and hit that one. I would have went long there, but it hasn't given it to me, so I can't chase it. And I'm not really interested in it now because it's moved too far away from it. So far, NASDAQ is staying inside its opening range. That's the highest high here and the low. I'm watching this wick right here, halfway point. should have pulled a fast one. I should have executed, on the ES and kept the NASDAQ chart up. They're watching me on the NQ, pull a shell game on them. Boys in Chicago. There you go. There's a pop through. All right, so NASDAQ is shaking off any willingness to want to go lower. Didn't even take the sell side out below here, which to me is pretty neat. Denied me an entry on this order block, denied me an entry at this order block. So we are seeing some shenanigans. You enjoying the show out there, buddies? I'm still gonna fuck this shit up in Robbins. I'm not live streaming news. So it's a little too expensive in here for NQ. So my attention will go to ES. I see you. You don't think they're watching me? Of course they are. Just for good measure. It's interesting, isn't it? I can call all the candles as long as my stop is not placed in there. As soon as I make a public stop, it'll go right to the stop. And all they're doing is proving everything I've already told you. Runs on liquidity. Yeah, I didn't get two of the chances I was looking for that NQ to get onto it before it ran up there. The premise I'm using is that we had this drop here, sell side below here and the sell side over here. I mentioned earlier right before the drop. So that's a breaker. And it's just spending, in my opinion, too much time here. If I were them, I'd stop me and then run it. Because it's not just my stop there, it's every one of you that have placed your stop loss right there too. They don't care about the calls being mentioned. They don't say, oh, let's go after that move because he's mentioned it. But if I put a stop there, you're all following that stop loss. And that creates and engineers liquidity. It doesn't negate a trading methodology. It just proves the methodology that it's going to go to where the largest pool of liquidity is, the easiest path of least of resistance. It's going to jump right there where that liquidity is. And since Nasdaq failed to go lower to take its sell side out here, where the S&P did go lower down here, taking its sell side out. I mentioned this in here. Is it going to support price? And we see that it did. And then we're inside this area here, which is the last up close candle prior to the drop down. That's a breaker. Price should run up into this buy side and join NQ in its higher high of the day. So it's like a six sister. So I was using six sister, which is one index is leading the other. It's not SMT. SMT is for measuring the turning point. where it takes place at what specific price level in comparison. While markets are in movement, Sixth Sister is when there is a price run that is being led by one or two of the indices, and one of them is reluctant, it won't join it, which is what we were looking at with the NASDAQ. I shorted the NASDAQ with that premise in mind that it would catch up basically and move lower for a run into a lower low, at least aiming for these down here. And my intentions were, if it were to have done that, my stop would have been lower than my entry, just to cover what would be considered hypothetical costs, which are nothing because it's in a paper trading account. But I have it set to what commission costs would be, like if you were trading with Ant Global. That's what I have set in place as a setting on my trading view. So if I do an execution, the numbers reflect that that's what it would cost me. It's not perfect, but it's just a rough approximation. So that way you're not just getting a sugar high. Oh, this is what the market would have paid me here, and not factoring in commissions, NFA fees, and whatnot. But because NASDAQ wasn't able to get below here, and S&P has already done its work by going down here, and then NASDAQ went to a higher high, the premise is stops have been taken, first order of rebalancing has been shown here, then this breaker. Again, spending a little too much time. It needs to be on this candle or the next. It needs to start running higher. I'd like to see NASDAQ start going higher too. Now just really pull. All boats rise in high tide, basically. We're at a really sweet spot for manipulation. Like it's a perfect area where the market can really beat up both sides of the marketplace. They can beat up bears, they can beat up bulls, and they can also frustrate both by keeping it in narrow ranges and then shooting it off into liquidity that's been generated. So it's not easy right now. Don't by any imagine or stretch of the imagination think that it's easy. It's not. Not at this moment. But the year is young. So many opportunities waiting. All the stuff that's going on around the world that's going to cause commodity prices to go crazy. Slow. I wanted to see when I first put my initial entry here in the stop loss where I put it right underneath this low, and I was wanting this to stay entirely open. I didn't want to see it come back down into that area at all. I'm still not out of the woods yet. I mean, it could still just come right back down there and pull my head off in front of everybody. And but this gap here, it's a continuation of this candle, this volume imbalance, and this candle here to that candle's low. So all of this area above the inversion fair value gap here, that in my mind, I wanted to see this little area stay entirely open and not go below the low. And that's where I have my stop loss. So true to form, I'm sure there's lots of you in here that want to take that same idea and you placed your liquidity there too. And it's a very narrow range, and it's easy for it to be driven right down to it. Excuse me. So it's not that I don't want to help other people. You know, if I have a winning trade, you know, I would want nothing more than to be able to say, here, join me and take that same winning trade. But the dynamics behind it doesn't facilitate it, because you're literally creating a bullseye on yourself by having that and sitting out here in a live stream. It literally puts a bullseye on it, and it's proven, because listen to what I was doing at the opening range today and what I was looking at yesterday, when there was no execution, zero. I knew exactly what it was reaching for. It was explained. But until liquidity enters the market, they're not gonna make a run on a opinion of a candlestick doing this or doing that. There's nothing, they can't capitalize on that. But as soon as you enter the market and you have your orders resting in the marketplace, then now there's a reason to drive the market right to that liquidity, proving the very functions that I tell you, that price runs on the basis of liquidity. What liquidity? Above and below the range, which is time, not price, it's time. How far do we look back? Right now, for E-mini S&P, the buy side's right here. See how just lethargic it is? Really difficult. And let me see. I don't like the Dow. I'm just going to pull it up just to contrast it. Yeah, it's trash. I loathe the Dow. It's only 30 stocks. It's not even worth trading it. But ICT, I got paid out. I know. Okay. All right, it's 1 hour trading has passed. We've not seen the E-mini S&P reach for its buy side. NASDAQ has created a higher high. It's just hanging aloft above. So I'm going to collapse this and sit still for a moment. Try to get a better read on what it wants to do. Big decoupling. They're not moving in tandem, and you want to be in a market environment that's symmetrical, meaning that they're going to move. I mean, they can have a cracking correlation, being the Dow, the NASDAQ, and the S&P. They could have that disconnection as they're moving lower. If you're bullish and one fails to go lower, then that's S&T. That's a welcomed decoupling. It gives you a timing aspect. But you know, if it's not in both directions, you know, both directions are not being confirmed, I'm just gonna sit out, just wait and see what I can find. If that means I can't do anything the rest of the morning session, then that's what it'll be. But I'll stay with it and see what we got here. Hang on a second. So because they're both not moving in tandem, they should be moving in concert with one another. If there's going to be an SMT divergence, where the market goes lower, one fails to go lower with it, and you're bullish, that's SMT. That supports the idea that they both, at that time, should start moving in tandem and agreeing with one another. As highs are broken, the other should see highs broken in relative terms. So whatever high was in the place of, the last 15 or 30 minutes, both indices should be breaking those highs. One will probably break their highs prior to the other, but they should be eventually moving in that direction. And if it starts getting really lethargic or it's showing no willingness to want to move, that becomes a suspect market where it could become range bound. And the S&P never clears the higher high in the morning session until we get into lunch. But calling the candles and explaining what it should do and what it shouldn't do, and behaving that way, it proves concept. But as soon as you place a large interest in terms of liquidity, everybody dogpiling in where I'm at, it's just like a candy store. They're just going to go and snatch it up. It's easy. It costs them nothing to reprice to that pool of liquidity, and they can still resume sending it some price they had intended for the earlier part of the day. So again, my point was, it's not that I don't want you to follow me. It's just to do so, I create too much of an interest where it could be a pool of liquidity easily snatched, just like that. And would I capitalize on that? No, it would hurt me and anyone else that follows me. So it sounds, to someone that doesn't know how the markets book or even how to trade, it sounds like an excuse. But every single time I talk about it and I'm not in the trade, there's no liquidity placed behind that idea. Every candlestick or idea I'm referring to, it does exactly what I'm saying it's going to do. But as soon as I put that stop out there publicly, boom, it runs right to the stop. So it's, for someone like myself, I want to help you do that. Like, I want to do that, but it's not feasible because you're all going to create that very counter liquidity that would upset my trade. And if you're behind me in that same trade, you won't see a gain out of it either. If I had like 5 people follow me and it was a group of 5 people and no one talked about it, then obviously then it could be easily done. But look how many people are here watching it today and how many people were watching it yesterday. And it's not conjecture, it's not contrived, it's fact. I mean, you can see it. It's been proven. Now, I'd like to see, I'm going to take just the number part of the entries and exits off, that the errors will stay up there. Okay, all right, you see this gap over here? I'd like to see that act as inversion. No stop loss, no liquidity. Watch how it behaves. Well, don't put your trade on ICT, just talk about it. He just read my mind. I ran all these scenarios in my head. Every single one of them you thought of, I've already thought about it. You get my drift now? If I execute on it and put a stop in on it, you're going to copy that, and it creates a large pool of liquidity where it would be below the marketplace. The price would drop down there, hit it, and allow buyers that come in at that cheaper price, knock me and whoever else is following me out, and it goes higher. That's how markets book. That's how it books. That's how it works. And you think that I don't want to do it for other reasons. It's because of that very reason. And I've said it before, but you don't want to believe me. I'm not going to get in here and use like a 20 handle stop loss on that E-mini S&P just to make sure I stay in a move. You know, it would take a gross repricing that would be so exaggerated and obvious. I mean, extremely obvious at that point, just to go down there to hit that stop out. But that's poor money management too. So think about what I just pointed out to you, okay? This is a high frequency trading entry. An old inefficiency over here where price moves lower. If price is going to run for this liquidity and above it, and we're trading here, this old inefficiency has been offered in what? Sell side imbalance, buy side inefficiency. It's a down close imbalance. So sell side delivery was offered, and then to efficiently rebalance that area, it needs to offer buy side delivery or candles that are moving up. We see it here. Okay. So when the market goes back through it on this candle, this inversion fair value gap is acting as a very small little micro balance price range where it'll be a real support level. There is no support that you can draw from here from a retail perspective. And to do so, you're really creating some kind of horse shit. you're going to try to make up something there. But this is all part of what I teach. And the fact it went right down there, I said, now watch that. Okay, and then price rallies. This price run here, that right there, is essentially silver bullet. It's also, when I did Twitter Spaces talking about you go for 5 handles in the S&P as a low hanging fruit objective. You know, there it is. That's an example of it. Now, do I sit out here and keep putting stop losses out here publicly and letting them run them, and allow the infants that don't know nothing assume that the market doesn't respect what it is I'm teaching, or does it prove what I'm teaching and it's running for that liquidity? Because every time I talk about it and I'm not executing, it's doing exactly what I say it's going to do. Not sometimes, every time. And that part, admittedly, is a little bit frustrating for me because I do want to see you do what I know is possible for you. And if I could sit here and do it and show you the stop losses that I know they wouldn't be able to run on, it had to be a wider stop. And I don't use really wide stop losses. So it flies in the face of, I wouldn't be using the logic that I trade with if I did that, right? So that's why I'm not showing or live streaming my Robbins executions. Either I fail or I do well. And if I do well, you'll see me on the leaderboard. If I do what I intend to do, I'll have a new higher world record than Mr. Williams. That's all I'm going in there for. I'm not in there to try to be the number one for the year. I'm trying to beat Larry Williams. Respectfully. But I can't have everybody behind me saying, come over here, we dare you. Because they will. I would. I ain't got any shame in saying that. Anybody that has the ability to do it, they would do it as well. So now, think about it for a second. For S&P, we had the sell side over here. Oops. Sell side over here, I drew your attention to when NASDAQ was being reluctant to go lower. I said it looks like ES is going to drop. I gave you this level here where the sell side was. Where did it go? Right down to the sell side. And then it came back above it. I said, now we want to see if this gap here on a 30-second chart, see it right here? That's this candle's low, that candle's high, extend that forward. Did we wick outside of it? Yes. Why? Because wicks are where the damage is done. The bodies tell you where the bulk of the volume in the narrative is. It's signaling that this very area that I told you to watch and see if it supports price, it's in the live stream, okay? Scrub back. I don't hide the ability for you to rewind it. It's there, you can do it. And I don't delete my live streams, by the way. This one won't be deleted either. You can't learn. If I'm going to make the time to show you this stuff, and if it doesn't give me the outcome that I wanted to show you favorably, for me to delete it, first of all, it's a little bitch move. It's a poor character demonstration, and I'm not afraid or ashamed of it because I understand what's going on here, and I also know that these are not going to be streamed when I'm in the Robbins Cup trading it. They're going to be just like I always do, off camera, but you can't fake it there because it's only allowing me one account to trade with. But this area here, does it support it with the bodies? Look at that body. It closed right on the low of it. See it? So that right there is a signature that says, yes, the market will start repricing higher. So what do you look for? This breaker right here. I put a stop loss in here, expecting this area to stay open. Went right down to the stop. And then what? Meanders. We wait for NASDAQ to push higher. All boats rise in high tide, meaning if this is going up, the tide should be rising. So S&P is another boat in the same water, so it should rise as well. The market rallies, supports ES with the breaker, rallies up, and I told you the inversion fair value gap over here, right there. What time is that? 9:30. 30 seconds after 9:30. So in this 30-second time frame, that's our first what? Imbalance. It becomes rebalanced once it goes up into offers it and breaks away from it. So it's offered both passes up and down in that little candlestick right there that's highlighted. That pass down lower, and of course that is based on a 1-minute chart. I wanted to go in a 30-second because that's where I showed this imbalance here. And admittedly, if you're new, this is a whole lot of plate spinning to be referring to constantly, and that's why it's not easy. It's not easy to do this, but this is what I do. So I cycle through the time frames because that's what an algorithm would do. It would go through one time frame down to the next, down to the next, down to the next, and it's looking for inefficiencies and liquidity. And once it makes one single pass, then it reverses direction and starts looking for the opposing side of either if it was seeking downside or sell side or discount, then it'll switch to seeking premium. And it'll go for inefficiencies above price or short-term highs where buy side is. And that's all that it does all day long. All day long it does that. And buying and selling pressure have nothing to do with it. Think about it for a second, okay? Really think about it. If it's buying and selling pressure, how could I predict that insignificant little price range was going to support price before it did it? That means I'm predicting the buying pressure. That's nonsense. That's nonsense. I'm looking at the areas at which the market itself will respect. Or if it doesn't respect it, then it gives me another side of that narrative or a different perspective. Then either I have to reverse my expectations or sit on my hands and do nothing. So the market did in fact support it here. We did go up in the breaker. The inversion fair value gap here that has been repriced to and becomes a balanced price range. A balanced price range is when a range of inefficiency or a dealing range, it could be a larger price range. So a balanced price range is not limited to just inefficiencies. When you have a market that has traded both directions, up and down, in between a defined range, where it's easily discernible which this is the highest high of that range or trading range to this low. When it's traded back and forth in there, okay, once it leaves that range, it doesn't matter which direction, once it leaves that range, it will act as real support or resistance. And because price was sitting right here, it was sitting right in here, I said, watch this fair value gap here, and dragged it out. And I'm going to go back to the 1-minute chart, which is what it's drawn from right there. I pulled that out, and you see it right there hanging on. And I did, absolutely. I was going to go for it. I was going to go in and do 2 contracts. But if I did that, it would have been like, well, you didn't drop down. So I ran through all kinds of scenarios in a matter of a few seconds. I felt like it could have panned out, but also knew that if I put my stop loss down here, it could just wick down here, grab me, and then run, and just further, frustrate me in front of all of you. So I just said, I'm just going to call it, because they can't run on anything that's called out. There's no liquidity behind that. So when you weigh all this stuff out, you can see that the concepts in fact do work. So much so proven that if I create with my presence in a specific price point, saying this is where my stop loss is, if that's in the marketplace, and a large percentage of you are doing that same thing, because your belief is, I'm here doing it live streaming, not to try to embarrass myself, not to try to do it foolishly, to do the very things that I do when I'm doing my other trades. And I'm trying to do that. But if I make that stop loss public, it creates all the focus to, okay, there's a big pool of liquidity right there, right now. It's not like I'm moving the market down 50 handles. It's in close proximity, because I'm trading how I trade. I'm using a respectable amount of risk. It's not exorbitant. But if you all dogpile behind me and you're doing that same thing, it becomes easy to pick me off and pick you off. Not to be personal. It's not impersonal. It's just that's what the market does. That's what it does. It jumps to where that liquidity is. So if all of you are trying to do what I'm doing because you have belief and faith that I wouldn't be out here trying to do this if I didn't believe it's going to work, right? And where I say it's going to behave and how it's going to behave, it does. But I also am not stupid, okay? The more times I do this, I don't need to do it this many times to prove what I'm trying to say is the real core reasons why I don't do signal services. I don't do come and watch me in front of the world, because look how many people here are watching. It's just a small percentage of that. Perfect example. I don't need a book map, okay? I don't need a book map. I don't need level 2 data. I don't need ladders or anything like that. If you watch where I make my stop known, that area will increase. So I'm creating and engineering liquidity for them to fleece. So if I sit out here, I'm actually being counterproductive to you. For someone that doesn't know how the markets trade or book, or doesn't know how the markets operate, that sounds like an excuse. But anyone that's been trading for a long period of time, that's just obvious. That's where all the orders are going to be at. So it goes without saying, that's where the market's going to jump to. And it could still unwind and go where I think it's going to go, clearly, yesterday and today. And for people that say, well, you always do it off screen. Yes, of course. This is the reason why I do it like that. I can tell you what's going to happen clearly here, and like I did yesterday. Everything is in conceptual form. It works. But if I put my stop out there publicly, it's a perfect target. It's a perfect target. And for some of you that will be too ignorant to understand that, I'll let you have fun. You can take pop shots all you want. But those excuses, okay, what you are making up, they're not going to hold water here in a couple weeks, okay? That's all I'm saying. The stuff that you see me do off camera, that's what's coming. and it'll be measured on that leaderboard. Okay, it's just a simple wait and see. That's all I'm saying. But I was encouraged to see the folks yesterday talk about in the comment section, and some of them actually were trying to defend me on Twitter. You don't need to defend me, folks. Really, you don't. Okay, but it is funny watching everybody get their confidence up, beating their chest. But the observations of observing what it is I said was going to happen yesterday, how difficult it was going to be in a range, and in the latter portions of the day, that 250 to 310 macro, you want to focus on that. And I left you at the live stream saying that I had still faith in that, 513 buy side and above it. And at that time, 250 to 310, it ran to it exactly as I traded it. Off camera, yes, but it was still an execution. So that's, I leave it to you as the audience member. Okay. I mean, did you see me outline anything here that moved? Yeah. Did I place my stop publicly? Yes. Did it run right to my stop? Yes, it absolutely did. Yesterday, I was looking over and watching how fast, as soon as I put the stop loss on, until it took the time for the latency from whenever I talk here live streamed to when it would be received. It was like about that much time, and then all of a sudden it's like right to the stop loss. And then it wouldn't go anywhere. It would just hang around the middle of the range. So that's a little frustrating, admittedly. But it's not something I'm embarrassed of, because it's proving everything I've ever said about it, about the market itself. Wherever that pool of liquidity is, that's where it's going to draw to. And if I create that liquidity, not willingly, it's like I'm not trying to. That's why I say don't copy me. But you're still going to do it because you think that I'm going to catch a big 100-point run, and you want to be a part of it and go on social media and say I did the same thing you did. And I don't like that. Not that I don't want to see you make money or be profitable, but it worries me, because I don't want any of you following what it is I'm doing. You should be able to see the market on an independent basis and take those trades all independently without me doing it. And you'll be in a smaller area of liquidity where they're not so eager to get to. When you're trading, the point I was saying earlier about the book map or whatnot, as soon as I put my stop loss in the public eye, that price level will swell in interest. Meaning, I hope I'm saying that right. I think it's book map. Book map. You know what I'm talking about. Most of you understand what that is. I think Patrick Whelan used. I want to say it's book map, but if it's not, it's whatever that guy puts up there, and it shows like these bubbles on the chart. Whenever I make my stop loss public, you can literally see it swell up and it becomes bigger. Okay, so if it can be seen like that, and we can see it on level 2 data where it'll appear that this is how many contracts are sitting at that price. The longer the stream goes and price is moving around, it hasn't gone there yet in terms of a stop loss, the more interest is going to build around that same level. So if you're walking down the street and you see a wallet on the ground and there's some 20s and 50s hanging out of it, are you going to walk by and just let it sit there? No, you're going to pick it up, whether you're honest or you're just like, well, I'm just going to grab it and take it, and I'll take the money out and ditch the wallet later on. If you're a person with no character, that's what you would do. But either way, your eye's going to go right to that wallet. And you're going to do what? You're going to engage it. That's what price is going to do. It's going to do that very thing. So if you're a trader, okay, and if you want to build up to be a larger trader, or you're going to try to do something like I'm going to try to do this year, you do not want anybody trying to piggyback on you, because I'm going to go as high as about 75 contracts. That's the highest I'm going to need to go to beat Larry Williams. I won't need to go higher than 75 contracts. He was trading thousands of contracts, but the ranges were smaller back then too. He had the advantage of cheaper margins. It doesn't matter. It's still math. It's all math. But I'm not going to need more than 75 contracts. So when I get above 50, I'm going to be splitting my risk between two markets, because I don't want to be building these big bullseye. Oh, there's a big block of orders sitting right here. There's a big block of orders there. But that won't need to be done until the last month and a half. It's all percentage growth. That's all it is. And I'm watching this right here. Right there. Let me draw it down real quick. I got a lot of questions or statements in the comment section yesterday. Was I nervous coming out tomorrow, which is today? And or was I embarrassed from yesterday? No, it's literally proving everything I've ever said. So why would I be embarrassed about that? I made a killing yesterday afternoon. What am I worried about? So I'm looking at, does it want to support price here and send us up into a run into that high right there? So all-time highs, as a reminder, I don't have tools that give me any kind of advantage in that. Like, I don't know how far it's going to go up. I just subscribe to the idea it's going to go up. And nobody knows how high it's going to go. So because it's an unknown, you just got to hopefully get into a good discount price, buy it, wrap your arms around it, close your eyes, and then just see where it goes. And it really is just like that. Because there's nobody, honestly, nobody knows. No one's going to know how high it's going to go. And they don't ever know when it's going to reverse. They may get lucky and have a piece of it or get near it. But there's no way to determine market reversals on a long-term basis because they can always go back here one more time and sweep it. See how we dug into that little down close candle right there, which is essentially half of that gap. Let me put that little midpoint line on it. See how that down close candle right there, that's an order block. We came just into the body of that candle right there on that wick. And this one here went to essentially half of that wick right there. And it's at the top of that inversion fair value gap. So I'm watching NASDAQ over here to see if it will support that idea in its price action. Because if this drops, this will give way and go lower. So you're going to constantly, even though you don't see it, like when I'm showing the examples, when I'm doing executions and whatnot, I'm balancing what my belief is around the market I'm trading in relationship to the NASDAQ or vice versa. If I'm trading the NASDAQ, I'm looking at other screens that you don't have. You're not privileged to see it because I'm only trying to capture that one chart. I'm referring to how the price is behaving in a closely correlated market like these two indices are. Now over here on NASDAQ, you see this gap here? I'm going to do the same thing here, but for that one. See that? So if we can get above it, excuse me, if we can get above it and come back down and it provides support, then I want to see it run and create a higher high. A lot of people want to sell short. They want to be the person that picked the top. There's a guy on YouTube. I'm not going to say his name because it would be rude of me, but he's like, the stock market's going to crash and Bitcoin's going to 100,000, and Bitcoin's been struggling while the market has been raging higher. And if you keep throwing it out there, it's going to happen, it's going to happen, it's going to happen, it's going to happen. Eventually, when it does happen, your dog and pony show that. See, I told you, but all the other times you were wrong. because of that idea, people wanting to try to pick the top in the stock market and say, I called the crash. You know, I tried that a lot when I was younger. You know, every day trading the market when it was going up. I mean, look at 1995 to now. And imagine, you know, every other week thinking that the market's going to crash. It's going to crash. It's going to crash. If you look at 1987 or even the 2000 correction, they're like a small little retracement anymore today with the volatility we have. But all through the 90s, I had to keep taking buy signals. I didn't trust, early on much of short selling. It was a long period of time for me to trust going short. And I'm thankful in a lot of ways because I could have got hurt if I was trying to sell short because it was in the beginning of the biggest bull market that ever was. And everybody wants is an SMT divergence right now. You see that? See that NASDAQ has failed to make a higher high where S&P has done so. And at the time, right now, we're at 6 minutes after 11. So that's a little problematic. So on all-time highs or markets that are trading at all-time highs, how do you trade them, or how should you engage them? How would you study them? How would you practice in them? How would you tape read them, paper trade them, whatever? Look for pools of liquidity that would be sell side. We saw yesterday it did that very thing and went down, cleared the sell stops, and moved higher. Today, same premise. It was able to pick it up on the S&P, but NASDAQ was just unwilling to do so. So because the underlying sentiment for most traders, they'll be interested in going short. They want to sell the market crash. They want to pick the top. The market will offer a decline and reward them with a very short, brief passing of time where they think they picked the top, or introduce a measure of price action running lower where they know traders will chase it, and they'll be doing what? Selling, 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 creating buy stops above the marketplace. But they're dropping price down into old sell stops for people that are already long. So they're knocking out really close trailed stop losses while being long in the marketplace. So it clears the sell stops. Smart money buys those sell stops, knocking out the people that would capitalize on the new higher high that's going to come. And it runs on the buy stops that are engineered on those individuals that think they're selling the high of the market. And they sell those purchased sell stops to the waiting buy stops. So they have to create a high, create some narrative that it looks like it's a shorting opportunity. So that way liquidity would be resting up there. If they don't do that, there's not going to be a significant amount of liquidity. If there isn't, then what will happen is then that price will run way past the high, which creates a new shift in sentiment. And that's this paradigm that constantly is in flow in what these markets are doing constantly. So in short, buy sell stops. When markets are at all-time highs, every single time the market drops down below a clear, obvious pool of liquidity, and you saw me do that with the S&P, well, look at it. Look how it behaved. And that was the sell side down here I drew. And that was the inversion fair value gap. I told you to study and see if it supports price. And I told you the breaker. And then this one here gave you the last little piece. What is this little piece right there? What's that little, what was this setup here? What do you see? Market maker buy model. Second stage reaccumulation. paired up with what you see on the left side. I just realized I didn't put a video up last night. Oops. Sorry about that. It'll be the supplementary lesson to Model 6. I apologize. I don't know why I didn't do it. I thought I had it already set up, but it didn't. But this is the second stage of reaccumulation, and it clears what? The original consolidation and trades higher. Smart money reversal, low risk buy, accumulation, reaccumulation. It's got to match on the sell side of the curve when it's dropping down. Everything over here that becomes a buy has to match something over here on the sell side. That's why it's not Wyckoff. Okay, it's not Wyckoff. A market maker buy model and a market maker sell model is absolutely not Wyckoff, because you're matching up what was used over here to act as a premium will act as a discount array over here. The curve is defined by the lowest low or the highest high in a sell model. So to the left of it, everything that's in inefficiency, like a fair value gap or order block or breaker here, this becomes all of the discount buying. So you have to wait and look at this sell side of the curve to present something over here. I mean, did it rally off of that range when I drew it out? Of course it did. Of course it did, because that's what price is going to do. But there has to be, an agreement over here, or it's not a market maker buy model. And it's not support and resistance. I had another guy, he said, "Oh, I'm renaming Elliott Wave." Elliott Wave. Get out of here with that horse shit. That's the worst thing out there. It's so much conjecture, it's opinion. This wave count, that wave count. And you ask 15 guys, they're all going to have different ones. All right, so we're back inside of S&P's range here. This was the opening range high. We're at the sell side. We've cleared this sell side here, and did we get here yet? Yeah, we did. One more time in there. So we'll see what we get off of this. If it fails here, then we have this area where I was originally interested in seeing stay open. That might become a factor. So I'll just put some lines there because I don't want the charts to be too busy. Model 6 and Model 7. I don't recall if I said it because I've done so many videos over the years, and I don't remember where I said what. But Model 6 and Model 7, I've been asked rather by a lot of students over the years, out of all the things that I teach, what's the closest thing to how I actually trade? Because there's a lot of ways to make a model. I can make models. I could do one with you here today before we leave. In fact, I might even do that. But the idea of what I make available as a model and publicly releasing it, which one of them is the closest thing to what I actually do when I'm trading with my own money. And it's Model 6 and Model 7 because it's a universal model. And that means you can use it every time frame. Any time frame, every time frame. And it's based on this premise. And I literally just did it again in front of you today. Just like I did in other live streams, calling it out loud. This is what's going to do. This is why I should do it. And it behaves perfectly. So if I were being asked again, and I'm sure some of you in the audience, whether you're listening to this video later or here right now during the live stream, if you ever thought about what out of all the models, which one would you pick? Because that's what you want. You want to hear me say, this is my best model, and you'll just focus there. I mean, obviously, that's exactly if I could go back to being 20-year-old again, and Larry Williams, who was the only person I was really subscribing to, this is the person that knows what he's doing because he's proven it. If he would have said, this is my only model of choice, or this is my only indicator settings, and this is the indicator that I'm going to use, and I only look at this, and I don't need to do anything else. Well, what am I going to do? I'm going to go right there. That's exactly where I'm going to go, right? So I think that is the closest thing, and it still isn't really everything, obviously, but out of all the models that I have released and or will release, what I teach in Model 6 and Model 7 in those charter price action models. That is the closest to what I do. That's not Enigma. That's not, you know, every aspect of what I'm doing, but generally, that's how I'm doing it. So if I'm bullish, you know, I can be buying the buy side of the curve of a market maker buy model, which is what this is here. Okay. If I'm bearish, I'll be selling short the sell side of the curve, which will be the opposite side, you know, the down movement. But if I'm short-term bullish because I expect it to go up to create a reversal to go lower, I can buy during the buy side of the curve of a market maker sell model. And it's easier to understand it here, where I could be going short here, be bearish, and aim for liquidity. And if it's going down, you know, underlying premise, higher time frame, because we're at all-time highs and nobody should try to pick a top in the marketplace, going down to take sell stops. It's going down there to accumulate those sell stops, to buy them, and then start moving higher. You won't have the experience to determine this turning point, which is why it's called smart money reversal. You don't need to know that. Once it comes up in real time today, I did it with you. This is where you'll see the low risk buy form. That's here. And the market rallies up. We have a shift in market structure. It goes into a breaker and eventually gives you your second stage accumulation at the last premium array over here. And then boom, right there. So, and the market does what? It rips higher, digging into the liquidity that's leveled higher and higher and higher above that high. It looks a little too sloppy for me now. So let me just give you a model real quick, just to show you how easy it is to do it. If we understand what I'm going to be teaching you in greater detail in Model 6 and Model 7 of the price action models on the YouTube channel, you can create a model out of just components of the sell side of the curve of a market maker buy model, where you're looking for just individual components that would give you your setup. So, perfect example. Let's say you've been trading for a long time and you could see that they were going to go to that sell side like I did this morning with you. You could be buying that. That's your turtle soup. Okay. That's where you do your work as a long buyer. Okay. Some of you that don't have the experience, but have a little bit more experience than the average person, when it starts to rally up, your eye goes over to the sell side of the curve here, and you see this single candle right there, which creates what? On the 30-second chart, let's go back into it real quick. That's this candlestick right there. That's the sell side imbalance, buy side inefficiency. So the market rallies up. What do we see in this time frame? An inefficiency and a swing high. Shift in market structure, there, bullish. That low's intact. It's done. The low's in. You don't have the experience to trade that, go long yet. This is where you go in with a low risk buy. Using what's on the sell side of the curve to the left of the lowest low, this is your first array. Carry it over to the buy side of the curve, which is anything to the right of the lowest low here. See if it offers what? Support. The market does what? It rallies, creating the signature with the body saying, okay, yes, the bodies are suggesting that it's supporting price. If you're ever looking at an inefficiency, this is also for your notes, since I framed this inversion fair value gap on the 30-second chart, I would demand that the bodies are respecting it on the time frame I observe it in. On a lower time frame, the bodies can be outside of that. Okay, real big, huge milestone right there. Okay, whatever time frame you see the inefficiency in, to have faith in it, to trust it, and to use it for your setup, it must respect it by its bodies. This is a mohawk. This is errant price action that we allow for. It's normal. It doesn't change or undermine the underpinnings of what we're trying to trade on. So the market rallies up, and then you go back over here, and here is your old high. Carry that forward. What is it going to become once it trades to that level? A breaker. Well, it trades above it here. We trade back down into it. This breaker, okay, was formed on the 30-second time frame? No. It was formed on the 1-minute chart. But you can see the bodies even in this lower time frame. Look where the bodies are closing and opening. See how they're inside of that candle? It was framed on a 1-minute chart. See how it's staying in there? We're getting wicks, yes. And I tried to be fancy and free this morning and put my stop loss there, and it came right down into it. So, you know, there you go. But the bodies were telling the narrative that I was on side, but I'm not going to compete with them if they're going to run my stops. It rallies up, and then right in here, what is it doing? Every PD array can be scaled. Upper quadrant, midpoint, lower quadrant, and then you have the extreme high and low of it. Much like I did with the opening range, where I measured the highest high and the lowest low of it. And then there is the upper quadrant, the middle, and the lower quadrant. That is not quarters theories, okay? Quarters theories, study that, okay? And then look at what I'm doing here. I'm taking you into a specific PD array, okay? Opening range isn't a PD array. It's a range of inefficiency. That can be scaled and measured. Every PD array has that same aspect to it. So if you look at the range that's created with this breaker that was used on the 1-minute chart, it's jumping right there. So I gotta use the bodies. So help me get it right there. I'll take the extensions off because that's not what we're looking at. 75 and 25. Okay, there's your breaker. Look at that right there. That's on your upper quadrant. Yes, it wicks down a little bit, but it's going into that small little fair value gap right there. And this is all occurring on a 30-second chart. It's crazy, ain't it? And then the market rallies up. And then we create the last premium array on the sell side of the curve over here. And it trades into it here and then sends it up. Every one of these individual price points, like that could be your model. Like you're always looking for the unicorn. The unicorn is a second stage reaccumulation in a market maker buy model, or it's a second stage of redistribution in a market maker sell model. That's where your biggest price run, the most energetic, the one that has the most magnitude, the immediate run, bang for your buck, that's the one you want to be looking for. That's why I call it a unicorn. If you're looking for moves, it's going to be very energetic. They're just really quick. They start running for you, and they just give you instant gratification. That's the one you should be aiming and studying, okay? But some of you may think, well, yeah, that's where I'm going to pyramid. I want to try to buy the first stage accumulation in a market maker buy model. Or you want to buy, the most advanced would be buying the smart money reversal, pyramiding at, and you've seen, go and look at my examples. You're seeing me actually do those things. This is low risk buy, accumulation, reaccumulation. So you'd be a buyer, pyramid, pyramid. So that's the most advanced version where you're doing like 6 contracts, 4 contracts, 2 contracts, 1. And there it is. And then you have all this area here where you would be layering where your targets should be, or where you're not your targets, your partial profits. And what could you aim for? Well, you have the breaker down here, okay? So you can take your fib and run it on your breaker using the bodies first. See it? This range on the bodies. This partial, is that a good place to take a partial? No, because it doesn't even do what? It doesn't even clear the original consolidation that this market maker buy model is creating for you. This could be a partial, sure. This could be a partial. And look where it turned. It's random, right? So if you missed your partial here and it's retracing and rally back up, you could take a partial there. But there's lots of things you can formulate your model on. You don't have to do every one of these. Some of my students think that you have to be in every part of a market maker sell or buy model, or you're somehow not profitable or you're not knowledgeable. That's not true. All you're doing is looking for one setup, okay? If you are buying it down here, no, in the starter, if you're buying it down here on a smart money reversal or close to it, your first objective should be at least get to this high right there. That could be your model. And then you are learning how to trust when it creates this, and in the next one, and in the unicorn, which is second stage reaccumulation. But in the beginning stages, you want to be able to set very low-hanging fruit objectives where you're buying down here, look for that high to be taken out and be done. And then paper trade the rest. I mean, not paper trade, but tape read it where you're not pushing any buttons. Or you could be waiting for this. This is your model where you buy it here and you get out right above here. And that's your very easy bread and butter setup, and those form several times a week. Yes, per week. Or you can get here on a low risk buy, and then you're getting out right at this high here. Right there, I mean, I've literally given you several models. And that's the power of what you're learning in Model 6 and 7, because it gives you a whole plethora of opportunities in how you can go in and scale entries, exits, where your partial should be. And I don't mandate and force you into a mold and say, only trade my market maker models this way. Because you're going to see one part of these models faster than all the other ones. And when you do that, start there. That's where your premise is. That's your model. That's the foundation you're going to build your model. It doesn't mean that you won't obviously evolve and know more and be able to do more of it. It just means that you have to have a starting point. And if you don't have a starting point, you don't have any way of gauging measurement of progress. And as soon as you start looking at it that way and you have measured progress, even if it's slow, it's very exciting. So anyway, this inefficiency here, we'll scrub this over here a little bit more. See that volume imbalance right there? I think I'm coming down with something. They know what I want to do. Run it, man, run it. All right, so this is too smooth here. And there's buy side up here. So they've really encouraged people to want to go short. And that's to me, that's kind of scary, because you're in a market that's just constantly going to rip the face off of short holders with no intentions of stopping anytime soon. I'm gonna go up to a 1 minute chart. So we've had a high today, broke lower, repriced to this SIBI, broke a low, came down to this buy side and balance, sell side inefficiency, and fair value got order block, trades up, old inefficiency here. We traded up into, is that half of that? Let me see. And it just fell short of it right there. Came down, took this sell side out here and here. Look where the body stopped. And that old inversion fair value gap that was used here. Watch this. Right in here. I want to see this area stay open. It would need to stay above the low of this blue shaded area. On a closing basis. This time frame, not any other time frame, just the 1 minute chart. Oh man, my back. Now, can price run up to the high end of this inversion fair value gap and treat it as support? I'm watching the NASDAQ on the left-hand side. I'm going to see it expand higher. All right, so we're in technically the lunch hour. Years ago, when open outcry was the thing, and traders would be in the pits, uh, some would start straggling away from the floor to get their lunch, as early as 11:30, and usually there would be like a consolidation during the lunch hour, and sometimes it would retrace and run on the stops. Okay, so I'll kind of go and paint a picture here from a narrative perspective. Doesn't mean I'm going to be right, but this is how I'm perceiving it. We are in a primarily strong market right now. It's been bullish. It's been moving higher. And no determination of how high it can go. I'm not going to sit out here and pretend to know where it's going to be going to. I don't know. So I keep subscribing to the idea it's going to go higher. We've had sell side taken here. And now we've had sell side taken here. We rallied up. We've broken down. And inside me, I think that there are people that want to go short. So they probably sold here. Some probably sold as it started to turn here. So where would their stop be? Here. So if we're going into lunch and lunch is going to run on liquidity that was used earlier in the day, and it's also in a market that's bullish, I would want to see it trade up into this high, okay, between now and going into, say, 1:30 p.m. Eastern time. since this is the time frame, I've annotated this area in here, which is both the volume imbalance of that candle, this candle body, and that candle body, because this is the time frame between that low and that. I'm treating this as a breakaway gap, thinking that it's going to keep it all the way open, not completely closed in. Right now, as of this moment, it has this portion remaining. That's still a breakaway gap in my mind. When we get into February and beyond that, I think we'll see a lot less of this type of ranging. It creates these early session runs, and then it goes consolidation, and in the last hour it gives you your little flurry. That's the other reason why I like wait until February, because in January you have so many things. You have post-holiday sentiment. Usually what happens in the beginning of the year is not how we end. So I'm not trying to read more into that or make you see something that's implied by there, but that's the general rules I've learned. So we might not be where we're at here at the end of the year, is what I'm saying. We might be we might be a lot lower 11 months from now, but where is that high at? I don't know. But February, it tends to clean up a little bit, a little bit more symmetry in the marketplace and less of this type of consolidation. Is if this candle closes below this area here, my interest is no longer held for this session, because we're entering into the lunch hour. So we have these relative equal lows right here. We swipe them. This can't be a breakaway gap anymore. At best, it can be just a fair value gap. It's very, very difficult to trade in this kind of stuff here. All of this ranging, it's very difficult to navigate in that. And same thing over here in NASDAQ. It's just very, very difficult to work on that side. You're not getting enough of disagreement between a high and a low. The premium to discount is so tight, there's not enough range in there to work with. And my minimum is 10 points, but 10 points can happen like that in the NASDAQ, and it's swiping back and forth all in here within around 10 to 12 handle range. That's not what you want to be trading in. You want to be part of a move that's going to be offering you minimum easy, once it starts running in your direction, 10 handles. And then can it give you 20? Can you lock in 10 after it clears a high if you're bullish, or clears a low if you're bearish? And then see what you can expand to. But this is another reason why you can see visually why I like to wait. I get, even when I answer it, they still ask me, what are you waiting for? Why are you waiting until February? If you know me, I do this all the time, every year. Because I want that first month of the year, because everybody's in a hurry to do something. And usually that something's wrong. So notice we wicked down beyond, which is permissible. Right in here where that volume imbalance is, I'll draw it out. Right there. And here. Can you see that? So volume imbalances in every other PD array, they can have a wick outside of it just a little bit. That's completely acceptable. The defining moment would have been if we would have closed outside of that, because it's been annotated on this time frame. So if it closes outside of your PD array, that's a violation. 3 of them that would support a trade idea, if they violate, that means for me, let me say it this way, it means for me that my trade idea is wrong. Or unless my stop loss is hit, then obviously it goes without saying that I was wrong. But volume imbalances, we always allow for those to color outside the lines. That's the one PD array that I'm very, very flexible with, but they still can act as a magnet for price. And it can be reused multiple times. But when they lay a body down over top of it, closing below it, in this case, if it lays a body down like that on the time frame, I see it formally, then I'm no longer personally interested in that one. So to answer the question that came up a lot yesterday also, you said that they can go back and forth. At what time do you discount it and no longer consider it a salient point? If there was a close laid down, then that violates the future use of it, because it can be used multiple times. Hopefully that makes sense. Because the nature of the PD array itself is there's no body between the candle here and the candle here. The wicks overlap between this candle and that one. And permit me to zoom in on this. I know it's rallying and all of it. Just let me get in here for a second. This body's closed and this body's open. The separation between these two bodies, that's what I'm annotating. It's this. That separation between the two bodies. So while there is a wick that traveled into this range that opened the next candle. It opened here, went down, and then went higher. The bodies are not connected. That's what makes the volume imbalance what it is. So the price can travel down through it, but if there ever is I'll just draw a crude depiction of it. If there's ever a body that's laid down over top of it, and it bridges both of those candles together, senior moment there for a second, if it does something like that, then I'm no longer going to use this on my chart or refer to it. Okay. You'll see going forward, or look at my old examples, and you'll see that's the case. I no longer have an interest in it. See how, again, for the asshats that like to come in my comment section, no stop loss was mentioned. It traveled down, colored outside the line, and is delivered. Okay, this is the part that I'm talking about all the time. The concepts work. I can see it coming, but they're not going to let me have all of you dogpile behind me. It isn't going to happen. You saw that yesterday and saw it today. So if I didn't know what I was doing, it wouldn't behave like this. So the question would be, ICT, if you would have taken that trade, where would you enter and where would your stop loss be? He read my mind again. Well, if we have the understanding that this volume balance can be traded through it, and that's acceptable, and this gap is framed on that volume balance to this candle's low, this candlestick right here, the stop has to be below that. And buying anywhere in this shaded area is fine. There's nothing wrong with it. Meaning that you can buy the upper quadrant, the midpoint of it, or the lower quadrant. The lower you get, the less likely you'll get a fill. So that's why you see me buying and scaling in. I'm usually using the upper half of a discount array because I'm trying to get established as the position is being offered to me. I may not get the best fill. Even though I can see it visually, the actual execution of it may not be within my grasp. It may not just afford me, my best case entry. So to remove all of that, because I'm obsessively compulsive, I just make it easy. It's okay, I'm not going to hem and haw about it. If I know it's anywhere in this range here, I could be buying. Earlier, what I was going to do, if you saw what I was doing, I went into the settings here and I turned off the executions, and I was going over to my cell phone because I was going to buy that down there and have my stop loss on it and let it run up to this high here and say, see, I didn't give you the stop loss publicly and it worked. But I realized as soon as I would have done it on my phone, the position would have opened up on the screen here. So some of you stupid people are going to say, see, he's trying to do sneaky stuff. No, I'm trying to prove a point. Okay, if I don't make the stop public, I'm confident that that trade will pan out. But if I make it public, all of you that are following me, you're going to make my stop a bullseye. You understand that? I understand if you're brand new, it completely goes over your head. And that's not a statement saying that you're an idiot. It's not. It's that you don't understand how these markets book. And I'm trying to do something that in and of itself will be permitted if there is no liquidity in the marketplace. That's why I'm right. That's why for years in mentorship, because I wasn't giving them actual entries and placing stop losses in front of them, I had a high 90% accuracy. And it's undeniable. Nobody that was ever a mentorship student has any record of me failing calling it beforehand. It was like all the time, clockwork. I know enough. I learned this on Merck, okay, internet relay chat, where I had 1,000 people follow me. When I talked about I'm buying or selling, we literally saw it happen where it would start running and ripping, because those same 1,000 people, I'm certain they were selling the same things I was talking about, and so on. Okay, and just look around. ICT stuff's everywhere. It's all everywhere, and that was what was going on in the late 90s. So we would see, and S&P is a huge market. Don't get me wrong, But we would see when everybody's orders were coming in, okay, it would start gapping. It was reaching. So you're going to say, well, that's buying and selling pressure. No, that's spooling. The market's going to rally. Like when we were looking at it here, I drew your attention here. I would have rather seen it come back and touch this. Use that inversion fair value gap again, but it didn't need to. Use the breaker right there, which is low, high, lower, low. Take that candle, extend it over right in here. Let me see. Am I right there? I might be wrong. High is 26.25, and the low on that is, yeah, it's perfect, 26.25. So I touched that one right there. But that's support resistance. You can call it that. I don't call it that. But it cleaned up all these little smooth areas here. So all this smooth area was made jagged. This smooth area right here with these lows and that volume imbalance, it overlapped it and then came back up. Did it close outside that blue shaded area? No. Did it stay a breakaway gap? No. So in your notes for breakaway gaps can be initially viewed as an expectation, an anticipation that it does not fill it in. And if it doesn't fill it in, what that tells you as the trader or the operator using the concepts is that that move is going to be significant in pace, in magnitude, and speed, and it's going to really probably deliver more than you thought was initially. So in other words, if this would have stayed open, let me give it to you in terms where it makes more sense. If this blue area wouldn't have been traded down to this degree and just a little bit outside of it, if it wouldn't have done that and it stayed open and started rallying, my interest would have been beyond this, and then over here I would have labeled that buy side. But this is where I have your attention, and that's what the market ran to. So I understand, trust me, I'm completely aware that entering a position, even if it is paper trading, because I'm protecting myself legally, putting on an entry and placing a stop publicly and it going to the stop loss, that's a testimony to what it is I teach. The market's going to jump right to that liquidity. You can't deny the things I'm outlining here aren't happening. It's happening. But if I place my stop loss in an area where I would realistically place it if I was trading, you see me in my executions, I'm not using crazy wide stops. But no one's aware of those stops. You know what I mean? So it's not like I'm broadcasting it on YouTube. Here's my stop loss. Here's my stop loss. Well, if I'm saying that, I'm a person of influence. And I'm not saying that to brag because it's a little uncomfortable, to be honest with you. But because of that influence, everybody that hears me or sees me do something, they're all going to try to do the same thing. And if it is being replicated in a lot of other people, it goes without saying, you're creating the very thing I teach as an attacking mechanism for my trades. I'm attacking liquidity. So if I go in and I make myself available publicly, here's my stop, I'm literally painting a bullseye on my forehead and saying, come get me. But for someone that doesn't know how to trade or doesn't understand how these markets book, it sounds like a perfect excuse. But why am I able to tell you what it's going to do beforehand still? I didn't quit and rage quit. I'm not deleting my stream. I understand what's going on here, and I'm trusting that the mature audience is going to see the same thing as what I'm saying. You don't have to. It's not worshiping me. It's not blindly following some guru cult leader. It's logic. It just goes without saying. If there's a big bullseye in close proximity to the price, and it keeps swelling with more interest placed behind it in the form of a stop loss, the market's going to go right to that stop loss. That's exactly what I was teaching all the time. Every aspect of how these markets book, that's the primary function of what it's doing. It's going to liquidity. It's running to that liquidity at a specific time. Well, I do believe I'm going to escape here because it's noon. It's done enough in here to satisfy me. And it may not have satisfied some of you, but I'm satisfied. One of the things I was talking to my wife and Caleb about is how I was very fascinating to see as soon as I made that stop loss public on each one of those trades yesterday, how quickly it went right to it. Like it jumped right to it. And today is a little slower to a degree in terms of pace, but still it did it. My question to you is this. If my ideal scenario was to be buying, because we gave you this idea, there's a support price, then we're going to see it go up, it's going to attack that buy side. Okay. If you see me going in here buying it and the stop loss was placed, I'll own it. The stop loss was placed at the wrong location. Okay. I'm not trying to place blame. I did it incorrectly. I knowingly placed that stop loss, knowing what I just explained to you and what I mentioned to you yesterday. I know that I'm creating that liquidity. Even though I'm in a paper trading account, there's a lot of you that are actually pushing a button. Even though I told you not to do it, you're putting real liquidity there. So it's going to jump to, it doesn't care about me because I'm trading here in this example in front of you in a paper trading account. There is no liquidity. But when I make that idea known that this is where I would, if I was risking real money, this is where I would place my stop loss. You, by default, doing the very thing with real money because you're greedy and trying to make money, and I understand that, but you are literally putting up billboards, sign up, here is where the largest interest is right now for liquidity. And it's the closest proximity to market price. What's the market going to do? Well, place a strong magnet underneath the desk and dump a cup full of paper clips. What's going to happen? If paper clips are every tick in the marketplace, all those paper clips are going to jump to where that magnet is. And that magnet is where my stop is being known and made public. Does that help you understand that? That's what's going on. Because I mentioned no stop loss here, it worked fine, didn't it? Don't just listen to what I just said and nod your head and say, yeah, okay, I believe what you said. Listen to whatever I was saying as it was dropping down in here. I don't want to see it close outside of that. What is the stop placement rule for a fair value gap? Would it be just below here? No. This candlestick right here, see it? That one right there. It's got to be below that. Did it trade there? No. Had I said and placed a stop loss there, it would have, and it would have traded right down into this and then did that. I'm convinced of it. And that's not schizophrenia. That's just, I've been doing it a long time. And to see it do what I already understand it does and do it so efficiently and quick, to me, it's fascinating. I'm impressed by it. But it also proved today that if there is no known stop, there is no target on my back. So then the market will do what? Exactly what I explained to you that it would do. Which is the reason why I was teaching in mentorship, in a paper trading account, and everything I talked about had no real liquidity in the marketplace to be targeted. But the market could be called with an amazing ability of precision. For years, daily, week after week, month after week. Month after month. Every single month, every single week, every single day. Which is where that little catchphrase and slogan came from. Because I proved it to that community. And no one has came forward and said, here's the documentation that says he got it wrong. Here. See, as a viewer yesterday, say this is the first time, and for most of you, it probably was the very first time, you watch me live stream and do executions in front of you. I don't usually do that for that reason. And you saw that very thing unfold. But understand something. I'm not hiding from people measuring my ability as a trader. I'm literally going into a third-party competition where only one account is allowed. I'm tired of hearing and reading these people say you can use multiple accounts. Contact Robbins and ask them if you can put 2 accounts in your name and trade in the futures division. See if you can do that. They're going to laugh at you. I talked to the guy on the phone. Don't take my word. Call him. Contact him. Speak to him. Don't believe these dumbasses, okay, that are trying to say whatever they want to say because they need money and clicks and clout and attention. Go find out that information on your own. You're going to find out that every one of these brave brass balled motherfuckers that are getting out there and trading in that competition, that's a real one. That's a real one. Because they're willing to say, hey, I don't mind going out there. I do this all the time anyway. What difference does it make if it's in a competition with other people? Who cares? If I don't win it, who cares? If I don't do better than ICT, who cares? You're willing to, it's going to be fun. It's going to be fun. Whoever gets involved in it, it's going to be a whole year of fun. It's just, I'm looking forward to it. But some of you honestly believe that this yesterday and today, you think this is going to somehow cause me to fear doing anything. Dude, I'm in it. I'm in it. All I'm waiting for is the email to say, okay, fund it. Let's go. And when it's funded, I'm going to make it public. It's funded now. And then we'll see what we see. Because I'm going in there with the express intent to beat Larry Williams' record. I contacted him. I spoke to him directly. And I told him, I said, 25 years ago, I sent you a letter. And I told you, out of all your students, I'm going to be that guy that beats your record. But I have learned a great deal from him as a young man, like much of you have learned from me. But a lot of things that built that foundation as a trader, some of the generic rules that I live by. I don't trade like Larry Williams, but a lot of the things that he instilled in me about thinking about the marketplace, they still resonate in me. Some of the things that he believed and taught then, and I don't know if he holds true to them today still, but I have made models that attack that premise. And my Power 3 was built on his public acknowledgement at the time in 1995 that he didn't understand how people could be a buyer below the opening price or near the low on big up days. So that's why he would take 20% of the previous day's range, add it to today's opening. If he's bullish, if it rises that much, he'll buy. I personally couldn't do that because I couldn't stand the retracements that would come. And I would get scared and I would get out the trade. And I told him in an email, said, my intentions are to go above your record, let it sit there, let everybody see it, say nothing about it. I'm not going on Twitter to gloat. I'm not going to champion it. I'm not going to parade it around like a little pissant, a peacock. At my house, I'm going to, don't you think for a minute I'm not going to be parading around the house when I do it. I'm going to do it. I'm just not going to publicly do it. Okay, I'm not going to do that. But I told him, I said, I'm going to drop it on a live stream 1% under your record. And I'm going to explain before I do the trade that this is where I really think it's going to go. And I'm going to go the opposite of that. And I'm going to live stream my last trade in the Robbins Cup. And it will be me going under his record by 1%. And that's me tipping my hat to him out of respect. When he's no longer with us, and if the Lord allows me to still be here, I will go back and I will double his record. Double it in half the time. But I want you to understand this year, we're going in like a cool breeze. I'm going in slow because my whole point is I want to prove silver bullet. It's the simplest thing I have. It's the simplest thing I have. And it works really, really well. It's time-based. It's real simple to see visually. So that's my, let me go back up. I was jawboning and I didn't get a chance to bring this to your attention, but that's what I said. I wanted to see over here. Go back and listen. I want to see it get above that. Treat that as support. Look where it stopped. See that? That's perfect. And look where the bodies are stopping. Above the upper half. I'm sorry, above the midpoint in the upper half of that inversion fair value gap. That's a signature. That's telling you we're really strong. So when I talk about this entity that's smart money, okay, who is that? It's people that understand how this algorithm books price. And there are things that are going on. Watch how we're going to run this high here. There are individuals that are not in the business of trying to draw attention to themselves. They don't write books. They don't make courses. They don't do teaching circuits. They're not on YouTube. They're not teaching people. My buddy met a smart money trader and they told me that the algorithm is going to stop in 2025. That's bullshit. Stop listening to people like that. As long as these markets are trading, this algorithm will absolutely be in play. Okay, they're never going to stop running for stops. That's the lifeblood of the marketplace. That's never going to stop working. Okay. There's always going to be inefficiencies in the marketplace. Always. Okay. And I'm quite confident in stating that everybody is going to be aware of time. As long as they're alive, they're going to worry about time. You're worried about getting to work late. You're worried about getting home in time to see your spouse. You're worried about getting your kids in bed by a specific time. Everything revolves around time. Why would you not understand and accept the fact that these algorithms run on the basis of time first? It's just you don't want to. You have a narrative that you're trying to sell. You're trying to promote an idea. It's infantile. It's too myopic. Everything in these marketplaces run by time first. Perfect example. Do you expect to see these large range moves in Asia? No. Why? You think there's not enough Asians to trade? Because if it was buying and selling pressure that did it, there's a whole lot more Asian traders than there are US traders. Well, that kind of just blows that whole idea out of the water, doesn't it? I get it. We are all, and I said we are all indoctrinated in the beginning by reading books and things. And while that's wonderful and gives us an underlying foundation to what the markets are capable of providing in terms of opportunity, it doesn't really communicate the truisms that go on behind the scenes. And there is a collection of traders that capitalize on moments that I have created a language around that I can't physically bring you to a point and say, okay, here is where the algorithm runs from. This is what it's going to do in reality. What I had to do was I had to create a language that has absolutely no bearing on anything retail. And anybody that says it's Elliott wave renamed, supply and demand, harmonic, Wyckoff, come out here and do a complete expose because I will give you $5 million fucking dollars in a bank check because it ain't there. It's not there. No, why isn't anybody said, I'm going to take this man up on his offer? Because they can't do it. Find this information I'm teaching you prior to 1996. It doesn't exist. It doesn't exist, folks. But it was very difficult for me to find a way where I could bridge that gap to what the algorithm is really doing that has nothing to do with a chart. It has nothing to do with it. It has nothing to do with a chart. But there's an overlap. There was an agreement that when these certain things take place, well, it just so happens that sometimes those charts create this enigma. And I dug into it and dug into it and dug into it and then started researching more about old moves before electronic trading. And I saw it, but it wasn't as perfect. It wasn't as efficient. Sometimes you would see it, like in this instance where I was talking about down here, sometimes it would close a little bit below that, but then resume. What was that indicating? That was indicating the inefficiency of non-electronic trading. That's why there was a big push for efficient trading in electric trading. That's why I was not an opponent of it. There's a lot of people saying, I don't want it to be like that. I don't want it to be electronic trading, especially the floor traders. It's very hard for a floor trader. That's why I like listening to the guys over at Top Step because they were there, they lived that. And a lot of traders, I'm sure they know, that never found their way to profitability once leaving the floor and going to screen only trading. I know some of them, not those individuals on Top Step, but I know old floor traders that couldn't make it and they just say, I can't do it. Some of them are in my mentorship and now they can trade. Hello. I wanted that electronic trading. I came up as a trader in that. My hands were in there doing all that stuff. So I felt what it was like to be in open outcry and calling in your orders and be at a payphone and wait, and sometimes your calls get disconnected. The market's still moving, folks, and it was scary. Here, you have no idea, especially you young 20-year-olds that think you know everything, just like I thought I knew everything. You know nothing. I didn't know anything back then. Even on my best days, I felt like a King Kong. I didn't know anything. I had no idea what I was doing. I had no business in there risking real money. I had no business doing that. And in the 90s, 1995 and 1996, it was the last few months of 1995. I was feeling myself because I had my first son in 1995, October. But I started teaching before I should have. I was just figuring out things then. It wasn't until around 1998 that I really had a grasp on what it was I was doing. But 2.5 years, just shy of 3 years prior to that, I kept trying to tinker with it. And then it would fall apart, and it wouldn't hold up over here. It would hold up over here, but it would fall apart over there. And what I was trying to look for, this symmetry where everything together fits together. Because if the market is in fact ran on an algorithm, if it's all manipulated and rigged and it's all like a casino and they're all in control of everything, then that means that every market should be in agreement to some degree. And my best trading, your best trading, is when all the markets are moving in concert with one another. That's the highest degree of high probability. That's when I'm going to be doing the highest leverage I can afford to do so in Robbins. Unless it does that, I'm not doing it. I'm not trying to have drawdown that looks like a roller coaster. I want to be steady Eddie. I'm not trying to go for grand slams. I'm not going to risk the equity when I get into the latter months. I want to be able to show that that silver bullet is a steady Eddie consistent breadwinner. And the aspect of money management and the effects of compound interest, doing the same thing over and over and over again, but with a different amount of money that never increases by percentage basis. Okay, so I've created a very specific money management approach to using what I'm going to trade with this year. Every part of that's going to be made available. Like every trade I'm going to do, I'm going to record it. I'm not going to live stream it because, as you can see, I've had so many people ask me, please live stream your entries and your exits. This was always my concern because I know if I put a big bullseye on, this is where my liquidity is. There's a lot of you that want to do everything I'm doing, and a lot of you literally parrot everything you hear me say, and you've never really done the research to see if in fact what I said is in the marketplace. You're just trusting because I said it. And that's never what I wanted you to do. I wanted you to go into the marketplace, study the charts, and see if what I'm saying is there. If it's not, then there's no reason to watch me. There's no reason to listen to me. Believe everything that everybody says about me that's negative and lies. But if you go into the charts, you will see exactly what I'm talking about is there. I have no fear being out here like this. Like, it's nothing for me to do this. Literally. It's going to repeat tomorrow. It's going to repeat next week. It's going to repeat until there is no market. The algorithm is not going to be recoded. Okay. No one's going to change the algorithm so that way all this stuff stops working. Because to say that, this is what you're really saying is, I'm an idiot. I don't know how the markets operate, and nobody's ever going to trade again. Because that's what it's going to take for it to not work anymore. There's always going to be new traders coming in, and there's going to be traders that know how to trade. There's going to constantly be trading. So therefore, what does that mean? There's always going to be liquidity. And there's always going to be these sudden movements, one directional, in every time frame, where it creates an inefficiency, where it's not efficiently offered price on both pass through, both going down and going up. That's an efficiently traded range of price, whatever that range is, whatever highest high and lowest low is. And what do I mean by that? In this area right here, between this, let me scroll this over here. Between this candle's low right there and this candle's high, I'm going to just annotate this. I'll say this and then I'm done because I'm hungry. I got to get something to eat. I'm embarrassed if I hear my stomach, that means you're going to be hearing it, and I just don't want you to do that. Come on, ICT, get yourself a sandwich. All right, so clone. All right, so that inefficiency right there from this candle's low and this candle's high. That little range in there that I highlight all the time with a shaded box or a rectangle, that's not a supply or demand zone. What's actually occurring there is the price engine drops the price quickly. It's not sellers that are doing that. Test it, okay? When you go through, record your screen, okay? People that have like level 2 data or like, I don't know why I don't trust myself saying bookmap. It doesn't sound right to me. I don't use it, but I know it's popular. But if it's not bookmap, you know what I'm talking about. It's that little thing that they show where supposedly the orders are, and it makes these big bubbles, which is to me atrocious. I can't even look at that thing. It drives me nuts. Study how many orders are in that run when it creates like this, and you'll be able to see that if you record your screen. You're not trying to trade anything. Just observe it. On a 1 minute chart, a 5 minute chart, and a 10 minute chart, observe it. And you'll see that there isn't a whole lot of orders that are traversing through the marketplace. And one of the biggest epiphanies I had as a trader early on was I was trying to learn how to use volume, VSA. Okay, that's kind of like what I was trying to do. And I was giving it some time to prove itself to me. And I got stuck in a market. Limit. Like it was going against me. Limit moves. And that means you can't get out of the trade. And I'm sure it's very fun, exhilarating when it's, working out in your favor. Anybody would want that, right? But what happens when it's not? And you can't get out of it. The broker they can't do anything for you. That means the market opens up the next trading day, lock limit, up or down. And if it's against your trade, you're stuck. That's a trader that becomes a Christian. He starts praying to God real quick. And apparently God doesn't care so much about traders in those days because he won't get them out of it. Okay. So how many contracts did it take for that limit up move to form? I asked this of Corbs when he did the face-to-face. He's the only person I ever give face-to-face to, except for my students who were being interviewed. But I asked him, I said, how many contracts does it take to make a limit up move or a limit down move? One. So it's not buying and selling pressure. That was the first epiphany. Okay, if we can move to the maximum daily allowance that the price can move for any one instrument, okay, it didn't take a lot of contracts to do that. So that means that price was offered there, and it's stuck there. Nobody can buy and sell out of it. Okay, well, that tells you what? Volume isn't everything. And it opened my mind up to start thinking, okay, I need to see what this looks like in price runs that are real quick. And what's actually occurring is you're not seeing a lot of selling pressure there. In the minds of most that don't know what's going on, they see this candlestick right here. They see this as a big candle with a lot of orders going short. See, that's in your mind. That's what you're thinking. When you say selling pressure, you're thinking a lot of people came in and sold this and pushed it down. They can't sell anything unless there's a buyer. Think. It's selling pressure. Well, what do you call it for the people that were on the other side of the trade? Because there's a transaction. It's a net sum zero game. You fucking clowns have no idea what you're talking about. This literally is the biggest lie that this industry promotes all the time. Buying and selling pressure. There is none of that. What's actually occurring there is this. Between this candlestick's low and this candlestick's high, man, I'm revving up, aren't I? I gotta dial myself back here. Hold on, give me a second. Let me get a grip. What's actually occurring, this would have been an edit point for recording and you wouldn't have heard the outburst there, but I'm live so I can't do it. This drop here, what's occurring is there's a gap between this price. I'm not saying it's this price specifically, but it may go from 28.25 down to 27.75, and there's no trade between the previous price and this one. There's no print, there's no booking of that at all. And then it goes down a little bit more and it comes back up, and it might print in that little gap that was created, or maybe just in a piece of that, but doesn't give you every single price offered by tick. So the smallest fluctuation in these indices is a tick or a quarter point. There's 4 quarter points in one full handle. In these fast runs like this, there's porous price action where there's little tiny little gaps. And the way you see that is with a 1 second chart, a 5 second chart, and you'll see, well, let me see if I can show it to you here. See this price run in here? Let's go into well, let me shade this here so that we were looking at a very specific range from here to where we're at right now, the high of that candle. Okay, and let's shade this an ugly yellow. And we'll go down into a 1 second chart. All right, price is fractal, meaning that there is no movement in price action that's not occurring in all time frames. And when I hear people say, I can't really trade a 1 minute chart because it's too fast. What the hell are you talking about? It's the same movement that's occurring on a 15-minute chart, an hourly chart, a 4-hour chart, or a daily chart. But what you're looking at is these little tiny little candlesticks, okay, and you're trying to figure out where you can place a stop loss and make all your decisions up, and it's moving. And that movement is scary. See what this did? That little gap, it came right down and priced into that. See that? What's missing in here? See that? What's missing right there? Those are small little micro gaps like this right here. See that? And then what does it do? It drops down in there and offers it, and offers it, and offers it. What's going on right there? The algorithm, the price engine, is offering this price between this here to there, because there was no trade booked, no print at all between these 2 price points. So the market will go down here and offer that. It doesn't matter how many people are buying and selling, because someone, and you see me doing majority of my entries are market orders, because I'm trying to prove by clicking these buttons up here that it's not market replay, because you don't have these buttons when you're doing market replay. That's why I do it that way. I don't like market orders. I want to use limit orders, because that way I'll get my price. And if I don't get my price, it's okay. I'll use another PD array to get into the move. I don't have to have my best price entry. I am not worried about my entries. My exits are what I stress about, because I want them to be better than they really are. And I'm never going to be satisfied, because it's like anything else. It's a pursuit of perfection, and nobody can ever attain it. But this little separation in here, it goes down and offers that price. Someone, some entity, some character that has a trading account is going to always go into the marketplace and buy or sell at the market. That's never going to stop happening, folks. That's never going to stop happening. People are always going to use limit orders. They're always, not every trader, but they're always going to use limit orders. They're always going to use stop orders, protecting their position or stopping into a trade, buying strength or selling short weakness. What I'm looking for is these little moments like this. Okay, I'm looking for these little moments right there inside of buy side and sell side inefficiencies, because that's where the market's going to reprice to. And if I'm bearish and it goes up into something, well, let me say it correctly, because this is being shown as the market's going up. If I'm bullish and if it hasn't traded to a target that I think it was going to be reaching for, some kind of draw on liquidity, I would have a limit order resting right in here and waiting for it to come down to fill that. And I'd be confident that the algorithm is doing that very thing to facilitate trade efficiently, because there's no trade between these 2 price points. That's algorithmic price delivery. That's something that it repeats every single day. It does it all day long, every single day, both directions. And high frequency trading algorithms, they capitalize on these little inefficiencies. So when we're looking at price, that's a 1 second chart. Here's a 5 second chart. Sell side, taken, rallies higher, comes back down, order block, rallies. Inefficiency, there's a wicks, not the bodies. This is all on what? 5 seconds. What does it run for? Buy side, rallies up, it breaks down, fair value gap, trades up into it, breaks lower, gap, Doesn't get filled. Breakaway gap, meaning what? It's going to run for sell side. Where's that? Right there. Where's it go? Down there. Your greatest epiphanies are going to happen by looking at price runs on a 1 and 5 minute and 15-minute time frame. And you may not have a membership to TradingView that affords you these sub 1 minute charts. And don't think for a minute that I'm trying to sell you on an idea to buy anything from that. I don't get anything. They asked me, full disclosure, they asked me if I wanted to have a partnership with them, and I declined them. And I could literally take you into, and if privacy wasn't an issue, because there's a lot of people over here on this little button thing here, if I click on that, in the top 3, the guy that is the representative for TradingView reached out to me and asked me, would I be willing to do something like that and promote TradingView? And I declined respectfully. I said, I don't do that for anything. I don't do any affiliate marketing. I won't accept any affiliate marketing. I'm not going to represent your broker. I'm not going to talk about your funded account or company. You know, I don't do those things. I may mention things in passing, but I never co-sign or tell anybody to go to anything, because I want to be honest. And the only way you're going to be able to trust what I'm saying is if I say everything on the basis of my own opinion and it's not monetized. No one's telling me, hey, represent me or represent my company and we'll reward you for doing that. So I say that to say that if you're using TradingView, I don't know what the membership is. You'll have to do that research on your own to determine what membership level you have to get the 1 minute charts. I'm sorry, less than 1 minute chart. But you don't need this to trade. Okay, I want you to understand, you don't need this to trade. But I get asked so many times, what am I looking at on these sub 1 minute charts? It's that. And it's no different than what I've already said about a 1 minute chart, a 5 minute chart, a 15 or any other time frame. But there are real gaps where there is no price printing inside that run. And the market has a very strong tendency to do what? Gravitate back down here because it wants to efficiently deliver both sides of the marketplace. An efficient market is this. In any range whatsoever, an efficient market between whatever price level this would be. Let's say, I have to end this live stream after I say this. If not, I'm going to go crazy here. You're already crazy, ICT. I know, and you love me. So here is representative of a down close candle, okay? And then say we have a later time, we have the market trade back up. And I'll explain this in a second. Let me color this candlestick. So I use a black candle for anything that closes bearish. And then I use a green candle for any candlestick that closes bullish. Okay. So if any range, whether it be a PD array, whether it be a dealing range, whether it be an inefficiency, whether it be a gap, an actual gap in price where there's no trading, efficient delivery of price is offered when it's dropping sell side delivery. It's not sell side liquidity, it's sell side delivery. It means simply the movement is going lower and the price engine just keeps offering lower prices. It matters not how many people are buying it. It will still drop. It will still drop because it's controlled. And whenever it hits this extreme opposite end of the range, whatever's going to be defining that for you as an analysis, then efficiently delivered price would see a move up. So traveling through a defined range of any particular high to any particular low, I'm always measuring and looking for the signatures that see these elements here. Sometimes you're going to see this. What is it efficient in? It's inefficient in buy side between this candle's high and that high. So that's not a fair value gap. But the market will reprice up there on another candle. It may be the immediate one, it may be a later one. And you'll see it do this. This run in here is where the market does its efficiently delivered price. It's a mechanism that constantly is gyrating up and down. And it matters not, folks. And the only way you can prove this to yourself is to study it with that in mind and start stripping down the price action. and then compare it to how many contracts are really being traded, and compare it to other price moves where you'll see these big runs. It's not the buying selling pressure, and it's not the absence of buying and selling either. Chris Laurie mentioned it's in the absence of buying and selling. It's not. It's not buying and selling pressure. It's completely fucking rigged. Okay, that's the reality. The market's going to go to these predetermined levels because it's going to go there. But it affords us as traders these little opportunities for us to get on board like a bus. Every bus route has multiple bus stops. Every price run has multiple points of entry. And I have 81 of those motherfuckers that I can get myself into them. Now, I might not be able to get on the ones I really, really want, and I might have to take a walk to get to, or jump on somebody's hood and get a ride down a couple blocks and beat the next bus stop and meet it there and then get on board and ride the rest of the way. That's trading. Okay, that's the same thing that's going on in trading. You're looking for a run on liquidity. You're looking for a reason for price to reach to a specific price point, and then be positioned to do so and manage risk in between. When you look at price like this, it's not anything retail. What I just described there that is not a fair value gap, that's not in any books. It will be further discussed in my books. And some of you think you already know what I'm talking about there. I promise you, you don't. But for others that have really been ingrained in studying, really, really in detail, this just opened up a whole lot more opportunities for you. And you started smiling right away as soon as I did, because you're like, I see that. Right. But what are you going to do with it? That's the difference. Everybody can see a turtle soup after it happens, but not many people can do it and call it before it happens consistently. Romeo. All right, so anyway, I think is there anything else I want to add to this before I close? I don't think so. Let's go on that chart. Take this off. So I'm quite confident you got something today. I'm sure you were entertained by me getting stopped out, and that's fine. That's good. If it makes you feel better about yourself as a student or someone that doesn't trade really well or doesn't like me, and it helps you get through the day with a smile, I'm thankful that I could help you. That's not going to change me not being successful in winning the Rollins Cup this year, because that's going to fucking happen. Whether you want to believe it or not, it's going to happen. But look at where we are down here. I mentioned that's sell side before it happened, traded there, and then once we got it, we got this inversion fair value gap. We got it. Then the breaker, we got it. I got stopped out. Rallied up in here. I told you this was the second stage reaccumulation of the market maker buy model, and then it rallied up the highest degree of the price move today. Then we had a sell side liquidity run here. We traded back down into the same inversion fair value gap that I gave you for the market maker model, buy model rather, second stage reaccumulation. And I know some of you that are brand new, you're just like, what are you saying? It's all in the Model 6 and Model 7 lecture and teachings. I just put 2 days ago, I put Model 6 initial video up. It's kind of like the presentation, the introduction to it. And then the next videos will be more detailed aspect of it. But we had sell side. Now, I said that we're in a primarily bullish market. And the way you want to trade markets that are all-time highs is you want to focus on, and this is my interpretation, this is what I go by. I look for sell side to be rated. So it's a turtle soup based model. And if you do that, if it's predisposed to go higher and they keep pushing it higher, okay, the better trades will be going long. So filter out all the shorts and every impulse of wanting to short. Just don't even do it. So marry the idea only in times where markets are trading at all-time highs, because you don't know where that high is going to be at. I don't know, and I swear to God Almighty, I don't know how to determine where the highest high is going to be in primary bull markets. I promise you, if I had an inkling, it would be a lecture for it. Okay, I don't have it. I wish I did. I don't have it. So, and nobody else has it either. Believe me, because everybody would know about it. Maybe not so much how they did it, but they would know that they were doing it, because they would bring forth evidence and say, here, I can do this. Like I'm showing you here, where I'm pointing out certain things in price action, and it respects it and behaves a certain way. They would have documentation to be able to say that same thing, and no one has it. So, but we had sell side taken below these lows here.
we went down into our inversion fair value gap. We wicked down through it, but did the bodies ever close outside of that? No. So that's a signature. It's like a boost of confidence, basically. It's a good way of giving an analogy of what I'm seeing when it does that. If it starts closing outside of PD arrays, and I'm in a trade and it is yet to get to my stop, if it does it for 3 PD arrays in the order of succession from where my entry was to where my stop loss is, if there's 3 PD arrays between that and it still hasn't yet stopped me out, I'll close the trade because I'll know I'm next. Okay. Some trades I don't have the luxury of having 3, so I have to just let my trade go to the stop. Or if it gets close to it, then I'll take some of the trade off and just reduce the risk. So I've answered a lot of questions right there. A lot of you have been asking. And yes, it's later in the video or the live stream, and it's usually how I do things, but you have to earn these types of details. Then we went into this area here. I said that I don't want to see it close outside of that with a closing basis, and it can wick through that. Why? Because it's a volume imbalance, and the nature of that very PD array is it can go through it back and forth until it lays a body down across it. It's usable. But once it lays a body down across it, meaning it could still be used by me at a later time. I'll have this on my chart until a body is laid over top of these 2 lines. But since there's no body, it's just wicks. This is a pertinent level to me in the future, still today. Okay, tomorrow and tonight, whatever. But yeah, if I don't stop now, I'm going to keep going, and I have to eat. Like I feel myself. Like I'm going like 20 hours, 20. Let me see, 19 and a half hours since the last time I ate. So I'm feeling a little bit hungry. So, and my stomach's not ready to start growling. So I'm going to try to get off here before that happens. So hopefully I've entertained you today. Hopefully I've given you some insight about some things, and I've called some market movement with details as to why it should behave this way. It was all here live in front of you. Nothing was done with the replay. Nothing was done, on a delayed data, apart from the latency between what YouTube collects from my live stream at the time and then projecting it to wherever you are in the world. It was about a 30-second delay, and I don't know how to overcome that. So I don't know how to do that. So it is what it is. Hopefully you've seen yesterday and today the illustration as to why I don't want to live stream. I'm privileged to have a very large following, and they love me so much that they know that if I'm willing to come out here and push the button, I have faith in what I'm doing. And if I put a stop loss on and it's made public, everybody's going to do the same thing. Everybody's going to do the same thing. And I, unfortunately, was an influence adversely to some of my students, like Tanya. I watched her. I didn't watch all of it. I watched a part of it, and I had to turn it off because I got emotional about it. For her to say that she was, considering a trade and then watch me doing something and it messed her up. That's exactly why I taught mentorship. If you're going to trade, don't even look at me, because you don't want to have a conflicted mindset. You don't want to have a divided mind. And because you have a regard for me that's high, and I appreciate and I'm thankful for that, I'm not infallible. That means I might do it wrong. I might do it wrong. I might do it more aggressive than you, and I might inspire you to do more leverage than you really would have done initially. Okay, so you can have me as a mentor, but if you're going to be trading, put me in the box. Don't look at me later on. So that way your mindset is clear. I've never heard Tanya use the F-bomb. And believe me, I'm capable. You heard this today in Twitter when I really go off the rails. I say it a lot, and it's not something I'm proud of. But I've never heard her say it. And she visibly and audibly was uncomfortable yesterday. And that, I apologize if I had any impact on that. That's the last thing I want to do for any student. But if you're going to be trading, tune everybody out, even your chat. They can chat amongst themselves, but if you focus on these candlesticks and what you're only worried about for yourself, you can talk audibly and let them hear what you're thinking. But as soon as you include them in the conversation, it's not your trade anymore. It's theirs. And now you got to live up to the expectation of them as the viewer. And then you're going to manage the trade based on what you're weighing out in terms of what they expect to see. And if you are a channel that's trying to grow, that's going to be a huge weight on your back. And it's going to make trading harder than it really is. As a 20-year-old, when I first started learning how to do this, I would never be willing to come out here in front of you. I was too insecure to do it. And a lot of you believe I'm insecure. I'm not insecure. I'm a braggart. I'm arrogant as fuck. I know this stuff like the back of my hand, clearly. But I also know my limitations. I know exactly how I will walk into a scenario where it can be made very easily and visibly questionable whether or not you should even spend any time learning how to do this. Because you watched yesterday and you watched today. When my stop is made known public, it's huge and it's a draw right to that liquidity. Did it run away from those stop outs? No. I mean, today, I wasn't willing to stay with it. I wanted to go back in. I was like, I'm not going to do it. I was going to buy at a later time too. I was going to do this one, as I mentioned. I was like, no, I don't want to do that because somebody will see that and say, oh, see, that's what he does. He does it off screen and he does it with 15 computers. Fuck all that. Explain how I outlined everything that you see here in the chart. Okay? Explain that because that happened in front of all your eyes. And I did this in the witness of a legion of people for years. And without any execution, it doesn't create pools of liquidity that would be big and would be an obvious draw on liquidity. That's the way it works, man. And it's fascinating to see how fast it ran to that. So that was one of the things I told Joel Robbins when I talked to him last Thursday, when he was asking me, what my thoughts were about letting people copy my trades because they offer that as a service. They're a business, folks. They're a business just like TradingView is, just like your broker is, just like anybody else is running a business. Anybody that runs a YouTube channel, you're running a business. You're trying to get ad revenue, and there's nothing wrong with that. I had nothing to say about anybody like that. But if I have monetization on my videos or not, YouTube's going to run ads on my videos, okay? Because I have a large following. And I had somebody leave a comment saying, well, but there's an Indian YouTube channel that doesn't get ads. That's bullshit, okay? Every channel with any following has ads running on it. I had to sign a disclosure clicking a box saying, I'm aware, a year and a half ago, whatever, that YouTube, whether I'm monetized or not, they're going to run ads on my videos. So if I'm not going to run ads on it, they get 100% of what would have been basically almost $700,000 in revenue off of my YouTube channel just last year. So think about that. You're just going to let somebody else have that money when you do all the work yourself? And nobody would do that. So stop with the bullshit. But you're going to have to get to a point where all this outside stuff, either this stuff works and you see value in it or you don't. Okay? It doesn't matter. To me personally, it doesn't matter. Like I love teaching. Look, I have a hard time leaving all the time because I want you to learn. I want you to learn. I want you to learn properly. I want you to have the right conditions to learn in. And I have tried my best to try to make it available to you so that way you can see it real time. And as soon as I put my stop loss there, you watched it happen. And then I outlined this area over here. How's that any different from me doing a trade when I'm not doing it live and I'm recording it? Every aspect of the trade is being recorded. I'm not having 15 contracts, or not 15 contracts, 15, 12, 10, 5, 3, 2 computers recording different things. I can't think about anything more than one thing at a time. And that's why I jump from one subject to the next. I can put one subject on pause, start talking about something else, and come back. And it's real hard to listen to me because it's frustrating for people that don't have that type of capability to keep up with someone like me. That's what makes me a bad mentor. It makes me a weak mentor because it's very easy for me to be distracted. And I have so many things I want to talk about, so many things I want to share and teach, and I don't have enough time, and I don't have the bandwidth in this body to be able to pour it out on you. And you don't have the ability to take it all in because it's like drinking from a fire hose. But nobody's going to be able to clown what was outlined today. And what I completely outlined yesterday about how the day was going to behave, and eventually in the afternoon, I gave you the very specific times that price run would occur, and then I executed on it, recorded every aspect of it. Here's our buy side right there. I was waiting for that to happen. All right, so now we're going to close it. So hopefully you got something out of this today. I'm not promising that I'm going to come out here and press buttons, but I am promising you that there ain't a motherfucker beating me in this Robin competition this year. And you can get mad about that. You can call me arrogant. You can hope and pray that I'm going to fail so you can clown and troll me. I'm going to fucking deny all of you that want to do that. I'm going to enjoy that. I'm going to moonwalk my ass into Chicago and get that pewter ass statue, okay, or that bull and bear that probably cost $100 at best. And I'm going to just put that as my border right on the YouTube channel. And I'm never going to mention it. I'm never going to say anything about it because there's nothing else to say. So I'll talk to you next time.